insured value is $590 million. The book value is $587 million. And the average size per ship is almost 34,000. The next slide that I have for you is the Baltic Dry Index, and it gives you an overview of the market going back all the way to 1985, right up to the current day. If we look at the same index but as an average per annum, then you can see that for the first half of 2013, we've had the second lowest BDI in history. The lowest being in 1986. So if we were to look at all the dry bulk commodities that are being carried, you would see that they fall into four main categories: iron ore, coal, grains, and other bulks. The very large ships, that is the Capesizes and the Panamaxes, mainly carry iron ore and coal. The Supramaxes carry coal, grains, and all other cargoes, and the Handysizes carry grains and all other cargoes. This chart shows you how the absolute values of these commodities are growing in terms of shipping space. If you look at the seasonal impact and look at the BDI over two sets of periods, that is 1985 to 1999, which is the blue line, and then look at the averages during 2000 and 2012, you can see quite clearly that in the previous or in the older line, that is the blue line, there is a very strong dip in the BDI during the months of July, August, and September. And this is largely due to industrial production in the OECD countries slowing down during the time of their holidays. If you look at the pink line, you can see the same impact of industrial production slowing down, but now it is due to the Chinese New Year holidays, and you can see the sharp dip that is there in January, February. But it is a very sharp, short dip and then bounces back very quickly, because unlike the OECD countries, China's holidays for New Year barely cover 2 weeks. Yet you still see some sort of a seasonal impact during the months of July, August, and September, even in the pink line, and that is mainly due to grain shipments which come to a halt during this period of time. The southern hemisphere grain shipments complete by June, and the northern hemisphere grain shipments only start in October. If you were to try to compare what happened in the last big recession in shipping and the current deep recession that we are facing, you would see during 1985, 86, 87, if you were looking at the annual asset values, that is the price of ships bought and sold at that period of time for an average 5-year-old, you would see quite clearly that the market was lowest in 1986 other than the Capesize sector, which had already turned around at that period of time. But all other sectors, including the Capesize, went up by almost 50% by 1987. However, if you look at 10, 11, and 12, all you see is a declining trend. So we have not yet hit rock bottom. In our opinion, rock bottom was hit in Q4 of last year and Q1 of this year. So 2013 will show you the lowest levels for the current asset cycle. If you were to look at operating expenses, you can see quite clearly that in 1985, 86, 87, these were declining across the board, whether it was Capesize ships or it was the smaller Handysize sector. However, if you look at 10, 11, and 12, you see a trend where the costs are continuously going up. If you look at the earnings per day per ship or 1-year time charter rates, you can see that during 1985, 86, 87, the low point was reached in 1986, and thereafter rates went up by almost 50% in 1987. However, if you look at 10, 11, and 12, all you see is a declining trend. And we think that the bottom of the freight cycle will also have been reached during 2013. Coming to the supply side, this is the latest situation of the dry bulk market. So if you look at the upper half of the slide, you can have the following takeaways. One is that the total fleet strength in the world in dry bulk shipping is about 11,000 ships. The average age is under 10 years, and this is about the youngest the world fleet has ever been. The total deadweight tons has increased to 716 million tons, and the average size of the ship is now a Panamax size of 67,000 tons. If you look at the lower half of the slide and look at the extreme right-hand column and look at the figures in brackets, it gives you the change that has taken place in the first half of this year on a deadweight ton basis in percentage terms. So you can see that the small handysize sector had the lowest growth rate, whilst the highest growth rates were in the larger ships in the Capesize, Panamax and the Supramax sector. If you look at the forward order book as of the middle of this year, then you can see that during 2013 there is another 60 million tons approximately of ships still to come. In 2014 that goes down to about 40 odd million tons, and thereafter the supply of new, or the order book for new ships, starts to tail off very sharply. However, even if you look at this, you can see that the majority of the ships on order is going to be in the Panamax and Capesize sector. If you were to add the pale yellow column with the bluish green column, you would see clearly that more than 70% of the forward order book is just in the Capesize and Panamax sector. Now there are two things that can slow down the supply side. One is of course scrapping, where you permanently remove ships, and the other is that there is a slowdown in the deliveries of ships. The order book says one thing, but the actual deliveries are lower. So if we were to examine the scrapping activities, you can see that during 1986, when we had the last big recession in shipping, younger ships as young as 15 years of age on an average were being scrapped. However, if you look at the 2012 block, you can see that an average age of scrapping is almost close to 30 years. Though in absolute terms 2012 looks like about 2.5 times the size of the scrapping in 1986, in percentage terms it is much lower as compared to the world fleet today, as compared to what happened during 1986. If you look at the slippage, you can see from this chart that it's been averaging close to about 30%. So if we were to apply a slippage factor of 30% and assume a 30 million deadweight ton scrapping per annum, then you would see that in 2013 growth rate would be about 7%, and in 2014 it would drop down to about 1.5%. Now if you compare that with the compounded annual growth rate which was established between 2009 and 2012, you can see that the large volume of ships, the tsunami of ships that was supposed to come in, came in during the period of 9, 10, 11 and 12, and from here onwards the supply side will grow in a much more normalized fashion. If you look at this particular chart, this is an analysis done by DNB Markets. It is from an 870-page report. Now what this slide tries to do is to look at the demand factors, but on a ton-mile basis, including slow steaming, including congestion, including underutilization of ships. So if you applied all these factors, you would find that the growth rate in the past 3 years has been averaging about 8% per annum. And on the same basis, if you were to look at the forward curve, then you would say that the growth rate would accelerate to about 11% per annum. So if we were to marry the last slide with this one, you would see that in the last 4 years, between 9, 10, 11 and 12, supply has grown by about 12%. However, demand has grown by only about 8%. So therefore you have a surplus of supply over demand of approximately